Hello, everybody. Welcome to Investing with Jimmy. Thank you for joining me today. We're going to cover today. It's going to be about my opinion of how the stock market works. So my from my experience, I would label the stock market as a Ponzi scheme. It's pretty much just like our monetary money that we have, our paper money. Really think about what money is. It's a piece of paper printed with ink. So the cost is the cost of the paper and the ink. Okay, so we're going to go ahead and start today right here. So you guys can see that on your screen there. So it talks about what's currency. It's just printed paper. The value is the paper and the ink. I tell you that this is worth $100. You go out and you earn you do work for this piece of paper. So you have a monopoly board is what's been created by the wealthy people who run the country. Okay, so human beings are telling other human beings what to do and when to do it, and they're doing it and controlling the entire monopoly board. Now, unfortunately, a lot of these leaders that have this type of power that are part of these groups, they're not doing what's in the best interest of American citizens. And also throughout the world, they're not doing what's best, the best interest. So let's go ahead and share now how the actual stock market works for those of you that are not really aware, and why it's a Ponzi scheme. And I'll explain to you how it works. So once you understand exactly how it works, you can beat the system. So basically, you have to learn what exactly that they're doing and how it works, and then you could go ahead and protect yourself and be successful. All right, so let's start with you have money, this printed paper for a stock. So we're going to say that I have 100. I see a stock that's available for $100 per share. We'll just use Google as an example. I see Google, it's $100 a share, and I want to buy $10,000 worth of this stock. Okay, so I'm going to get 100 shares, which technically is a digital image in my account. No different than how cryptocurrency works. So here I have this digital printout that I see that says I own 100 Google shares and the value is $100 each. So I have this digital asset, and now I watch the stock market and I see that Google has reached $110 right here, and we decide to go ahead and take the profit of $1,000 and we sell that Google stock. And we're going to make pretend that 500 people did the exact same thing in the stock market. So if you have 500 people who all cash out at the same time, it generates a total income of $500,000 that somebody has to pay. Somebody has to pay out that money. All right. Now, who pays that money out? Now, also, where does that money actually go? Well, I would probably say 90% or higher, it stays in the account. It actually never leaves the account. The institution, which is where the money's held, the bank, there's a bank behind it that holds these funds, and they only have to pay out for the people who withdraw from the account. So all of this money, this $500,000 that's leaving the bank, it really isn't leaving the bank. It's just updating the digital asset that you possess. You sold Google. You now have $11,000 in your account. You got your $10,000 back, and you got $1,000 profit. Okay. All right. So the next thing that we're going to look at is who pays for the money. Well, the losers in the stock market pay for the money. Okay. So when you have all of the people who, in this particular example, they purchased the same stock for $100. They have $10,000 worth, $100 a share. And instead of it going up, let's say that the stock was to go down to $86 a share. Now, the people who lose their money are the people who actually click the sale button. They sell the stock because they want to stop the bleeding, or they weren't prepared to be in this situation, and they're inexperienced, or they just can't afford to lose that money. So those are people who make mistakes. Either they bought the wrong stock, they bought a stock that was really vulnerable, or they weren't prepared for it to go down $1,400, and now they only have $8,600 left that shows up on the digital balance, and they're panicking because they know that they have a family to feed, they have a mortgage they have to pay, and maybe this is their life savings. So they panic and they hit the sell button and they take and accept the $1,400 loss. Now, if you have 500 people doing the exact same thing, now it generates a revenue of $700,000 on the balance sheet for the bank institution. So they now have $700,000, so they can pay out the winners in the previous example where they owed $500,000. Okay, so that money comes from the people who panic and sell. So losers pay winners. So you ask, well, what happens if the system teaches these people? Let's say you had nothing but professional people in the stock market. Let's say you had people that were very experienced, and only experienced people were in the stock market. Well, if you do the same exact example where the stock comes down from $100 to $86, but you have all 500 of those people that do not flinch, they do not sell. Their digital portfolio shows $8,600 in the account, but they haven't technically lost the money because they're holding. Now, the institution, the bank institution, shows that there is a $700,000 difference of revenue, because these people technically are, their digital assets are down $700,000 between the 500 people. So the institution realizes that their account pending is in the positive. Okay, but it's technically not their money. Well, it's not technically, it is not their money, but it shows them in the positive. But they realize that they need these people to sell in order for them to have those assets where they can pay out and things like that. So there's no available funds to pay out to these winners in this particular scenario. So where does the $500,000 come from? For all the people that did sell, whether it was a different stock, or there's winners and losers. So the people who took their money and said, hey, give me my money, they have to fund those money. So where does this $500,000 come with in this example if you don't have anybody selling? So what is the answer? The answer is it's a Ponzi scheme. That's what happens. So it's a manipulated, controlled market. The actual market, it has to try to shake off people so they can keep the ability to pay the winners and take from the losers. So they want a stock market that's constantly in turmoil, has its good days, has its bad days, has its good days, has its bad days. So I'll give you an example of what I mean. So let's say, for example, we go back to the Yahoo Finance, and let's take a look at Google. All right, let's talk about Google for a second. This is the perfect example of what I mean. This is a company that just had a massive profit quarter. They just reported earnings, and their stock went up to $164, I believe. Let's look at a 5-day so I can give you the exact numbers, okay? So look at the peak in the last 5 days, $170, okay? Their stock went up to $170, and look where it is now within 5 days. I mean, this was just in the last couple days. It's been around the 162, 163, 164 range. Okay. So think about that for a second. This is a company that just reported positive earnings for the quarter. They're so they're down. They were down yesterday, and now they're down today. Okay. So what happens is that you have this stock market, and let me go over here to the homepage, and here's what they do. Okay, so every single day, no matter whether you watch Yahoo Finance or you're on Bloomberg or you're on CNN, I don't care who it is. Every single person that's involved in the media understands what they're doing to promote whatever they're told regarding to push the agenda of the market. One, whether somebody comes out and says something, if they have to say something, they constantly promote bad news. I mean, so look at this picture here with these Americans. They got American flag over their head, and their heads are bowed down. They got this on the front, and it says consumer confidence plunges for 5th straight month. So you get all of these, negative promotions. Now, today's not a bad day. As a matter of fact, the Dow is doing really well. It's 40,479. I usually like to get involved when the Dow 30 is around 39,000. That's, 39,000 is a good indicator for me. The S&P I like to do when it's around 4,300. The VIC, I like to see that, go up more. So these are just things that I personally look for. Now, my interest, obviously, right today would have been PayPal. PayPal just reported, and it's up $1. It's up $1.17. So I was going to actually purchase PayPal this morning as soon as I saw it going up about 25-30%. And I would have easily made $1 or $2 per share, and I could have easily done that with PayPal. So you learn the game a little bit. So yes, when earnings are reported and companies are rewarded for what's coming in. So if somebody comes in and purchases PayPal, the system is legitimate when it comes in where you have a large amount of revenue pushing up a product. Okay, but that doesn't mean after it's been pushed up a little bit and stuff like that, that doesn't mean that they can't manipulate a lot of bad days for the overall market, because they're looking at the overall, market. They're not just indicating on one particular stock. Okay, so most of these stocks are showing a lot of strength. So for example, AMD, Nvidia, they're showing a lot of strength. The last 2 days, they've been losing a little bit, but they're holding strong. So that's a good indication that you have a lot of money pumped in those stocks where the people are not budging. They're holding their positions. That's when you're going to see results where people do not sell their positions. But the system is designed to put max pressure for their agenda. They will just keep pounding it and spreading the news in order for their figures to work out where they can control and manage the Ponzi scheme. That's exactly how the system works. Works the same way with, U.S. treasuries. Okay, what is the United States government doing? Is they have bond treasuries that they sell to investors, such as banks, things like that. So when people buy the bonds, the United States is saying, hey, we're going to pay you interest on the money that you let us borrow. We need to keep borrowing. We need to keep bringing money in, bringing money in, bringing money in, because they have so much money going out, which is a Ponzi scheme. Now, the Ponzi scheme that they're controlling is printed paper that they control. So you tell me how that you could ever really go broke by printing the paper with ink. You have to have enough money to pay for the paper and the ink. And then you're getting people to do bonds, and then you're just paying the interest. So the more money that you print allows you to pay the interest. And that's basically what's happening, which is why our budget's in debt, trillions and trillions of dollars and trillions of dollars, because it's a manipulated Ponzi scheme. So anyway, that's today's session, guys. I don't have a specific stock for you or anything like that. We're not really going to do a video today about a specific stock. I just wanted to point out exactly how the system works. And you have to have the manipulation in this system to pay out and to take from the losers. You've got to have it come down, and you got to have losers selling. So if I'm buying a stock, I'm going to make sure that it's a stock that I'm getting at a great price, and it's going to constantly come back from what they're trying to do, push down my stock. So for example, if you owned AMD, right now you have nothing to worry about. Most people that bought AMD are buying it around the $87 to $90 range. So if the stock is at $6 and you don't take your money, well, even if it came down to $89, you're only down $1 a share, or you're even. So there's really, so in other words, is the more you get up on your stock, the less damage or stress that you're going to experience if they start pushing it and pushing it and pushing it down. What they're doing is they're focusing on the people who bought AMD for this $96. Okay, so until this stock gets to 106, all the people who are paying right now this $96, it can easily be pushed down to 89. The question is are those people that are pushed down that $7 per share, are they actually going to sell? They need people to sell to generate that money. Now, the other way that they can generate the money is to just use funds that are in the system to pay people out. When they push down the market and not enough people are selling, they still have the digital balance sheets of the reality of where people are. So for example, if you bought AMD at $96 and now it's $89, but you did not sell, your balance of your digital printout in your portfolio is lower. So they use that as borrowed money to pay these people out. So what happens when they keep doing that? You have all of these stocks low. So what do they have to do? They have to keep lowering the stocks to get new money to come in to buy these stocks. And what do they do with the new money? As the stocks start rising, they start using that money to pay the people out. It's just a Ponzi scheme, guys. All right. Thanks for watching. Learn how it works. Watch and learn what the hedge funds, the people on Wall Street actually do. So you have to run it like a business, like you're part of their group. What they do, when they do it, you want to be a part of that. So when they come in on a stock, you can tell. There's a lot of things that you can learn on this channel. This is a new channel, Investing with Jimmy. Give me a like for the video. It helps the algorithm. I'm trying to grow the channel up so I can keep bringing you and educating you on good stocks to buy, when to buy them, when to sell. I'll show all of that on this channel. Thanks for watching, everybody, and I'll see you on the next one.